Hi, welcome back. In our last video, we talked about lot sizes and pip value, and at the time we mentioned that we had three broad classifications or categories of lot sizes. So we have the standard lot size, which is 1.0, and that is equivalent to a control of 100,000 units of currency. And the next one is a mini lot, 0.1 lot, and that is controlling 10,000 units of currency. And the third one is a mini lot, which is controlling 1,000 units of currency. And so at the time we mentioned that not everyone, say if your account is denominated in dollars, it means that this 1,000 units, 100,000 units is actually equivalent to $100,000. So if you were going to think of trading one standard lot, it means you will need to have available for that trade you want to get into $100,000 worth of capital to be able to do that. Not a lot of traders can actually afford to get a retail traders to have that size of account for each trade. And this is, at the time I mentioned that this is made possible by leverage, where the brokers provide leverage to allow retail traders or any other trader the ability to control way higher, control currencies way higher than what their account size is. So with a $100 account, you're able to control trades of up to $1,000, $5,000 in certain cases, or even up to $10,000 worth of currency transactions. And that's leverage, really. Now, the easiest way to explain leverage is using the concept of mortgage. Now, so someone wants to buy a house. So you want to buy a house, and the house is in the market for $100,000. Now, the option is to go up front with $100,000 to the seller, and then you've paid for the house and you move in. But for most people in the West, they actually obtain that same house, but not with up to $100,000. So what they tend to do is to have, the bank requires them to have an upfront down payment of, say, loan to value ratio of maybe 70 to 30, 80 to 20, 90 to 10, again depending on the area and the credit ability of the borrower. And so let's say with an example, the borrower goes in with a down payment of $20,000, and the bank then provides them with $80,000, and that is actually leverage. So you're able to put up $20,000, but you can control $100,000. That's absolutely leverage. So that's 1 to 5. So so with 20,000 you can control 100,000. So that's 1 to 5 leverage that the bank provides to the borrower to be able to control this sort of investment. Now, a similar thing happens in trading as well, where the brokers are able to provide the trader with leverage that allows them to have an account of $100, and then they can control investments of up to $10,000, and that is leverage. And the leverage that they apply in the USA is about 1 to 50 is by law the highest leverage that can be applied for a retail trader's account. And in the UK, just recently in August last year, it was dropped down to 1 to 30, as it were. Still, these are still significant amounts of leverage. You can see with the mortgage situation, it's only 1 to 5, as it were. And so bring 20,000 and control 100,000. In Forex trading, the lowest leverage, as it were, is 1 to 30, applied by the FCA, the Financial Conduct Authority in the UK, and in the USA is 1 to 50. In most other places is actually, it goes from 1 to 100, There people offer 1 to 200 brokers, some brokers offer 1 to 400. And I have seen in the past several years, I've seen a broker that has actually offered 1 to 1,000 leverage. These are crazy numbers, and you should really not be doing that. And if you can, my preference for leverage is to go for nothing more than 1 to 100. Okay, so now what is margin then? Margin is like the down payment. In essence, margin is what you need for you to take a trade, an amount of money you need to have available in your account to allow you to take that trade based on leverage. That's what margin is about. So it's like the down payment. So you will not get the 100,000, the 80,000 from the bank to buy a $100,000 house if you do not produce the 20,000 down payment. So also in trading, you need to have available a certain amount of money to allow you to take a trade you want to take. And so what is margin? Margin is simply, in calculation, the volume you're looking to trade divided by your leverage. So the volume you're looking to trade divided by your leverage. And just using a very simple example, if I have a 1 to 100 leverage account and I'm thinking of taking a trade with one standard lot, that one standard lot is equivalent to 100,000 units. And since margin is equivalent to volume over leverage, that will be 100,000 over 100, my leverage. And when you cancel the zeros out, it means I need to have available, the broker will hold in trust, just like a down payment, $1,000 for that trade. So if you have a $100 account, you cannot take that trade because you don't have up to the 1,000. And if you have a $2,000 account, it means the broker would put away $1,000, which means you now only have $1,000 for your trade, any other trade you want to take. And also that $1,000 is now the money you have around to help manage the trade you have open, as it were. So just in essence, what I'm saying is, if you have $2,000 in your account, you take a 1.0 lot trade, the broker takes away margin. Yeah, so straight away your account balance, so your balance before, as you just enter the trade, let's just assume that your profit at the time is 0.0. Yeah, so there's no loss, there's no profit. Your balance at the time will still be 2,000. Your available margin for any other trade, since you already have this open, any other trade, that will mean, so let's not confuse this. Your balance will be 2,000. Your used margin, we've already done the calculation here, it is $1,000. Yeah, so your available margin then, that free margin, available margin would then be 2,000 minus 1,000, which leaves you with 1,000. Yeah, now this 1,000 is now what is available to also help just in case the trade drops down to -5, -10, -15. So as that trade drops down for whatever reason, if it doesn't start to make money immediately, if it drops down, then this starts to go down as well. Yeah, and once your available, the percentage of your available margin drops to about 30%, the broker will close your trade forcefully, even though it's in a loss. But not because you have hit your stop loss, but just because you do not have enough margin to sustain that trade going forward. And so this is why it is key. And this also explains why a lot of new traders lose money in the market, because they've got small accounts, $100, they are trading 0.1, 0.5 lot sizes. And then what that happens is, with very low leverage, they then have only a small amount of available margin to deal with the drawdowns of their open positions. And then what happens? The broker closes all the trades, even though they took the right trade, but they did not have enough liquid asset because they were risking too much. So the rule of the game is you've got to trade small. As a new trader, trade small. Not because you want to make so much money or too little money, but just because you are in the process of understanding how to trade. So you reduce the external factors that are not really part of the trade affecting you, as it were. I do hope that is kind of clear. Maybe I'll just do one more example. So if you have a $100 account, so you have a $100 account and you want to trade a 0.05 lot, 0.05 lot. That is equivalent to what? 0.01 is equivalent to 1,000. So 0.05 would be 1,000 times 5. So that's 5,000 units. And if I'm going to then calculate the available margin I need to have in my account to take this trade, it will be equivalent to 5,000. And if it is a 1 to 100 account, my leverage is 100. Cancel, cancel, cancel. And that means I need to make sure I have $50 in my account. So straight away, if you have a $100 account, you can actually trade a 0.05 trade, but just be aware that you now only have $50 of available margin. And just imagine this is actually a safer trade to take. What's the pip value of this on the standard, say GBP USD, the pip value of this will be 0.1 cent. So for me to actually lose my other $50 that is in my account, I need to do what? Go 500 pips. So I need to go 500 pips in the negative to be able to lose my account, because 500 pips times 0.1 will be equivalent to, so 2 zeros will bring it to 1, 1, 2, so that's 10. So that will be $50. Does that make sense? I hope it does. But the fact is that if you have that one trade open, 0.05 trade open in your $100 account, and the broker has already taken $50 as a margin, you only have 50 to actually trade this, to support this trade. And if you then go down, in fact, before you actually get down to the 500 pips, the broker will close that trade in a loss, and you lose money on that trade. So I hope that makes sense. You will understand this once you start to make trades and once we start to go through this. But just please ask me questions to help you understand this better, or just watch the video over again to just try to get the concept. But once again, margin is like a down payment. Leverage is like in the mortgage situation, where with your down payment you're able to control even bigger amounts of capital to buy an asset. Is the same with trading. Okay, until next time, you stay disciplined. Just keep your head at it, keep trying, keep trading, be in the ring, don't get out, just be in the ring, stay as long as you can, because that's what makes you a winner. Okay, you take care, and let's speak soon. Cheers.